Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to work through a practice problem in Excel related to a consolidation where we have a parent-subsidiary relationship. Parent-subsidiary relationship that is not 100% owned, but we do have a controlling interest, and therefore we will have a non-controlling interest we will have to deal with as well. New thing we're going to be focusing in on here is the sale of bonds from P to S, so basically an intercompany kind of transaction we will have to eliminate. Bond sale from P to S, it was sold at a premium. Get ready to account with Advanced Financial Accounting. Here we are in Excel. We have the information on the left. We're going to be entering that into the blue area on the right with the worksheet with the journal entries, and then we're going to be entering that into our consolidation worksheet. Let's take a look at the information on the left where we have P purchased a percentage of S, P is the parent, S subsidiary, common stock on January 1st, 2000 X0. That's when the purchase took place. The controlling interest is going to be a 60% interest that was purchased at that point in time. The non-controlling interest is going to be 40%. And then we're going to have the purchase was at the book value, so we're not going to have to calculate the differential. Our major focus here is going to be this bond transaction and what's going to be the effect of it on our consolidation. So on January 1st, 2000 X0, P sold bonds to S. So it's going to go a sale from P to S, or issued bonds from P to S. Now, obviously, when we think about the bonds, it can get a little bit confusing to think of, which side are we talking about? Now, since we sold bonds to ourselves, we can get a little tied up in terms of, well, which way is this thing going? So remember that bonds is kind of like a loan. That's basically happening. So P is issuing or selling the bonds to S. Therefore, S, if you think about our trial balances over here, S is going to be giving money, right, to P. Kind of like a loan of money to P. P then is selling the bonds, promised to pay in the future with the bonds. So on P's books, we're going to include the bond, the payable, that what's going to be owed in the future at the termination of the bond and any kind of premium involved in it. And then S is going to be paying for the bonds, and we've got then the asset here, the investment in P bonds. All right, so let's think about the item. It's going to be as of January 1st, 2000 X0. That's when P sold the bonds to S. Par value is going to be the 78,000 of the bonds. The percent is going to be 8%. That's what's actually on the bonds. For the percentage, years are going to be 5 years. The cash received was 80,000. Why was it 80,000? Because the market price, the percent not on the bonds, market price was higher than the rate on the bonds. So we've got it being sold at more cash than the face value of the bonds. So the interest paid annually is going to be paid annually on December 31st. So we have the fully adjusted equity method is going to be used by P to account for S. The consolidation we're taking a look at is 2000 X1. So notice the purchase took place in January 1st, 2000 X0. Now we're talking basically 2 years later. So we have X0, X1, and we're going to have the straight line amortization of the bonds. So we're going to use a straight line method to amortize, in this case, the premium over here on the bonds, and that'll simplify things rather than the equity method. Okay, so let's think about the fully adjusted equity method here. So I'm going to hide some columns. I'm going to hide from H to K. So I'm going to put my cursor on H, select on over to K, right-click on the selected area, and hide those items. And let's think about our normal kind of equity method transactions for P related to their investment in S. We're kind of backing into this number. We're thinking about this number. And in this problem, we're also kind of concentrating on this one. That's an intercompany transaction. And we are concentrating in on, let's say, this one and this one. Those are some of the items that we're going to be particularly concerned with here. We can even go further than this. This might be going too far, but we got the interest income and the interest expense are also items we're concerned with. Okay, normal equity method transaction would be that the investment account is going to be going up, and we have the income from S for basically the allocation of the net income. So the net income would typically be that net income down here for S, and I'm trying to reconstruct basically this account here times the 60%. So that's what we would normally do, equity method stuff. Then normal equity method stuff would be, say, the dividends would have to be allocated out. So we're going to say, all right, then we got the cash. The dividends would be allocated out at the 80,000 or 8,000 times the 60%. And the other side here would be going to the investment. So there's going to be that. Obviously, the investment account is this and this, adding up to the 28.8. Does not tie out to what is in here because we only looked at the current year and not the prior year. However, if we looked at the income from S, that is tying out. That's what we have down here in the income from S. Now let's consider these bonds particularly, and we want to reconstruct what's basically going on in the current year, the second year, the second year after the bonds were issued, right? So the current year, what happened in the current year for P's books for the bonds. Now P sold, P's the one that issued the bonds to S, so you would think then at the end of the year, they're going to have to pay money to S based on the interest. They're going to owe interest at the end of the day. The bonds are already on the books, so they already put the bonds on the books. Now we're thinking about what's going to be a result in the current year related to those bonds, the intercompany activity in the current year. The bonds being on the books, of course, being something that we're going to have to reverse in the consolidation process. Now we want to think about the current activity, which is stuff that could affect like the income statement as well and affect our reversing entry. So we would say, all right, well then P at the end of the year would have owned or owed interest that they would have to then pay. And they also are going to be thinking about the bond premium that they'll have to be reducing, which we're going to use a straight line method to do. So you would think that now I often think about cash first because I think that's the easiest thing to first deal with, right? So even though this is going to be a credit because they're going to be paying cash, I'm going to put the cash on top because that's the way I would think through it. Generally. So I'm going to say, all right, let's put the cash first and say what would happen to the cash. Well, it would be a credit, so I'm going to put a negative, the 78,000 times the 8%. So they're going to be paying then 6,240. Now you would think the other side would go to the interest expense, but we also have to allocate out the bond premium here. So we have to allocate that out, and we're going to use basically a straight line method to do so. In other words, we're going to take that bond premium and just divide it by the number of periods because we're talking about things that are going to be paid each year and not semi-yearly or whatnot. The periods just equal the number of years, which in this case is 5. So I'm going to say, all right, the bond premium, and we're going to allocate some of this to the bond premium. The premium needs to go down. It's got a credit balance here. So to make it go down, we do the opposite thing to it, which would be a debit. And again, normally you could calculate this as saying this would be equal to, I'm going to put brackets, the 80,000, that was the original cash paid, minus the 78,000. And then we're going to divide that by 5 years. Dividing it by 5 years, that would be the 400. So the 400, and notice again that the original premium you could see here was 78 minus 8,000 or 2,000. It's already going down, so it's currently on the books at the 1,200. Okay, and then we're going to say the difference is going to be the interest expense. So then the interest expense is going to be here, and I'm going to then say negative sum of these items. So there we have it. So now the interest expense we can see is on the books, so we've kind of recalculated the expense. Here's the interest expense here. That's the one that needs to be, that should be highlighted. Not so much this one. So there's the interest expense on P's books, and of course the premium that we'll have to be dealing with up here. That's what happened in the current year. And then we're going to say, all right, then S books, what happens on S's books, which is the one that purchased the bond. What are they going to do? Well, you would think that they would receive the cash. So again, I would start with cash. So I would kind of reverse this thing out and say, well, they would get cash, which is going to be a debit this time of the cash up top. And then the investment in the bonds, we're going to say is going to be, part of that is going to be decreasing. The investment in the bonds, same calculation for the 400, negative of that 400. And we're going to, similar process here on this side. Then we're going to be saying that the other side is not going to be interest expense, but interest income. So now we're going to say this is going to be interest income, and it's going to be going up by the negative sum, which will be the same as this number. So there's kind of the mirror, the other side of what's going to happen. So then if you were to net this out, you could see, okay, well, if I was to calculate the difference, then once again, as we've seen in the past, the cash basically kind of nets each other out, right? We got the cash kind of nets each other out, but then we've got this, the bond premium is affected, and the interest expense is affected. The investment is affected. That's gonna reverse out. Hold on. This cash basically nets out. And then we've got the income here. So the bond premium is something, but it's going to be included in a balance sheet account. So we're going to have to reverse the whole bond out on the balance sheet side. The expense account is the one that we're going to have to basically remove on the income statement side. And then we have on this side the investment in P bonds. We know that we're going to have to remove, the whole investment needs to go to zero. And then this side, the income here. So the income and the expense, of course, is going to be something that we can see kind of nets each other out that we're going to have to eliminate in the elimination process. Okay, so let's go to the elimination process. I'm going to then unhide some cells from F. I'm going to select from F to L to unhide them. So we're going to go from F to L, let go, right-click selected area, unhide. Then I'm going to go on over here and we're going to say, all right, so this is what we have for P and S, books for P, books for S. Let's go ahead and sum them up. Standard process we've seen in the past equals the sum of these two items. I'm going to go ahead and copy that. And then I'm holding shift down and I'm just going to paste it all the way down. So there's what we have. We're going to enter our adjusting entries then in the middle. Standard beginning adjusting entry. So normal beginning adjusting entry, nothing new here. I'm going to say, here's our normal entry that we would do. Let's say the investment account. I'm going to put that in, not put the number first yet. I'm going to then remove S's equity section, which is going to include the common stock. And then I'm going to copy that and paste it down two more. Retained earnings and dividends. Common stocks on the books at a credit. So we're going to then debit it to remove it. So we're going to debit that. Retained earnings on the books as a credit. So we're going to debit it to remove it. And then we have the dividends on the books at a debit. So we're going to credit the dividends to remove them. Then we're going to say that we have the income from S. So income from S. And here we have that. That would typically be removed by taking the net income, 56,000, multiplying it times the controlling interest. So I'm going to do that here. We don't have any other kind of table that we've used here to change this. So I'm just going to take this times the 60%, and there it is, no problem. Then we're going to be taking the non-controlling interest in net income and taking the other portion, the non-controlling interest of this amount. So negative of this times 1 minus the 60%, or that 40% I could have taken. That's the 22.4. Then we have the non-controlling interest in NA, which is going to be the assets minus the liabilities, 164,000, or total equity, 164,000 times the non-controlling interest, 40%. So let's do that. I'm going to say negative sum on the credit side, assets and liabilities, closing it up times 40%. The other side is going to go to the investment account. Once again, assets minus liabilities, which is the 164 equals the equity 164. That equals the middle amount here, of course, 164, which is now going to be broken out 60% to the investment for the controlling interest, equals the sum of these, and closing it up times the 60%. And so there we have that. If we select all of it, it should add up to 0. We are in balance. Let's post it out. So we're going to have the investment account. Investment account is going to be equal to, we're going to pick up that 98.4, bringing it to 0. So nothing tricky here going on. We're going to take the common stock. We're going to record that, bringing it back to the parent number as we would expect. Same with the retained earnings. So everything is going as you would expect. And then the dividends, we'll do the same for the dividends, bringing it back to the parent number. Then Then we have the income from S, so that's going to be down below. Income from S, we're going to say that that will be equal to the 33.6, and that brings this down to 0, so nothing tricky happening here. That is good. Then the non-controlling interest in NI, that's going to be down below right here. That's going to be equal to the 22.4. Next, we have the non-controlling interest in NA, not net assets. That's going to be here in P16 equals the 65.6, and there we have that. Okay, so now let's go into kind of the new thing here, which is going to be, we're going to reversing the bonds information. Now we can think about this. I'm going to break this down into two transactions first, because once again, as we looked at, we could see that we know we're going to reverse this out. We know that's got to go. We know these got to go because those are intercompany bond activity. We know this has got to go and this has got to go, because that's all a result of the intercompany transactions, balance sheet side, income statement side. Let's try to break those out this time in, two entries, balance sheet, income statement side of things. So I'm just going to construct this based on what we know from seeing the accounts. This is what you'd probably be able to do in practice. You can kind of see these items being reflected on the trial balance. And so we're going to say, all right, well, I know the bond payable needs to go off the books. It could start there. I know that needs to go off the books. It's on the books here at a credit, so we're going to debit it to remove it, doing the opposite thing to it. We know the premium needs to go off the books because it's related to the bond, and it needs to go off the books, so that would make sense. It's on the books as a credit, so we're going to have to debit it to remove it. We also know that this investment in P needs to go off the books because it's that related to that intercompany bonds on S's side of things. So that should be the other side of things. So it's on the books as a debit, so we're going to credit it to remove it. That should balance out, so that ties out to 0. So let's do that first. So I'm going to say, all right, on the balance sheet side of things, this bonds payable's got to go down here. So bonds payable is going to be decreasing with a debit. Then we got the premium. That's going to be right underneath it, right here on P12, which is going to be decreasing with a debit. So that goes to 0 here. There are, of course, more bonds on the books that hopefully are not intercompany bonds that are still on the books, but we've removed that $78,000 and the premium related to it. And then we've got the 72.9. That's going to be here in P9. So there we have it in the 79.2, bringing it down to 0. Okay, now let's take a look at the income side of things, where we have these two income accounts, which clearly need to be removed because they're intercompany income and expense accounts. So the income account needs to be debited to remove it. So we'll go ahead and put it on top this time. Debiting that one, it's got a credit in it, so we're going to do the opposite thing to it, or debit it to make it go down. Expense account then has a debit in it, so we're going to do the opposite thing to it, a credit to make it go down. Let's go ahead and post those out. Here's the interest income. This is going to be posted here on P18, where we're going to say equal to, and that 5,840, bringing it down to 0. We've got the interest expense, this not being the only interest expense here, but we will be removing the intercompany expense related to interest expense, and then it goes down. So there's kind of like our intercompany bond transaction. We could see that these two went down to 0, and we've kind of removed, you want to check, the bond account, the bond related accounts, to see that they are going down as you would expect. And so that's our ending numbers, these two down to 0. Obviously, normal kind of checking numbers. We would say that P's equity is basically the ending equity. We basically removed S's equity, some things to check in on, and then, of course, removing the intercompany transactions related to the bonds on both the balance sheet and income statement.